I'm Jeff Zimmerman, CEO of Fullerton Home, and welcome back to Builder's View. The 1% rule, where the monthly rent equals 1% of the property's cost, is a classic shortcut investors use to gauge cash flow potential. But in Western Colorado's high-cost markets, that math rarely pencils anymore. Today I'm going to break down what the 1% rule really tells you, why rent-to-cost ratio is a smart metric for new construction, and how factory precision at Fullerton Home restores those ratios, making deals work again without pricing out local families. The 1% rule is simple. If a home costs $200,000, you want to make $2,000 per month in rent. It's a quick way to estimate if the property can cover operating expenses, debt service, reserves, and still produce positive cash flow. But the Rockies are a different story. Land costs are high, labor is scarce, materials are volatile. And short build seasons add weather delays and drive up carrying costs. That combination pushes new build prices well above where the 1% rule can hold. Most projects land somewhere between 0.6% and 0.9%. That doesn't mean the deal is broken. It just means that cost control becomes everything. You can't simply chase higher rents. You have to lower the cost base. The smarter metric is rent to cost ratio. Instead of looking at purchase price, this measures stabilized monthly rent, divided by total build cost, including both hard and soft costs. Let's use a simple example. A 1,000 square foot home rents for $1,900 per month. If it's built traditionally, on-site for $275,000, that's a 0.69% rent to cost ratio. If it's built in our Grand Junction factory for $200,000, that's a 0.95% rent to cost ratio. Same rent, better yield. That 25% cost reduction is what brings deals back to life and makes attainable housing actually attainable again. We build indoors, year-round, using standardized systems that control every cut, seal, and inspection. Materials stay dry, crews are sequenced like an assembly line, and site work happens in parallel with factory production. Here's what that means financially. For the budget, less waste and fewer change orders save roughly 20 to 25% of cost. Now for the schedule, weatherproof production cuts timelines by about 50%, reducing interest and carrying costs. And for quality, tighter building envelopes and fewer callbacks improve durability and NOI. By lowering cost base and shortening schedule, we raise rent-to-cost ratios, which makes projects financeable and more profitable. So for another example, we'll take a single-family home versus a community. Let's zoom out. That same 1,000 square foot home renting at $1,900 a month costs $275,000 to build traditionally versus the $200,000 in the factory. That's a $75,000 savings per home. Now apply that to a 50-home community. You've just created $3.7 million in capital efficiency. That's money that you can lower sales price, boost investor returns, or fund the next phase. Precision at the unit level compounds at the community level, and that's how scalable housing gets built. Now let's look at sensitivity if rents move. Markets shift, and that's okay. If rents rise 5%, the lower basis captures more upside per rent dollar. Either way, the project stays bankable and investors stay protected. That's resilience by design. Now let's dig into why this works in the Rockies. Timing is everything in the mountains. Most builders get 5 to 6 month weather windows. Miss that and you lose a full year of rent. Our factory runs 12 months a year. We build indoors while foundations are being prepped on site. When the site is ready, installation takes weeks, not months. From our Grand Junction hub, we can deliver homes to Aspen, Vail, Steamboat, Telluride, and Durango, all within hours. That geographic advantage, combined with predictable costs and timelines, restores rent-to-cost ratios in high-cost markets and creates a repeatable model for attainable housing. Now we're going to dig into sustainability and efficiency. Factory precision doesn't just reduce cost, it also improves performance. Our SIP and modular systems cut job site waste by up to 90%, reduce embodied carbons by 35%, and improve energy efficiency by 20 to 30%. That translates into lower utility bills for families, roughly $150 to $200 per month less, and higher net operating income for investors. It also reduces the need for large on-site crews, which is critical in tight labor markets. This is sustainability that pays off, financially and environmentally. The 1% rule is a good starting point. But rent-to-cost is the metric that truly matters for new builds. Factory precision makes those ratios work again, cutting costs, speeding timelines, and keeping homes affordable. At Fortin Home, we're building homes that are attainable, investable, and sustainable. Like, subscribe, and share this episode to help bring smarter housing to more communities. I'm Jeff Zimmerman, and this is Builder's View, where vision meets execution.